All right, we'll just give it a minute for everyone to come in after afternoon tea and then we'll get started. Okay, so our next session is all about lending tech and the evolving lending system. I recently went through the purchase of my first home. It's a very, very small one-bedroom apartment, but the process, let me tell you, it was disjointed and frustrating. So I can't wait to see what these guys are doing in the lending space. And on our next panel, we have Leanne Jones from Nemo Industries, Lisa Frazier from Judo Bank, Stephen Duke from Wayflyer, and moderating the panel, we have Stuart Stoyan from EY. Welcome.
You can do better than that. No, you can do better than that. There we go. Thank you very much. Thanks, guys. We're now in the slot, and after afternoon tea, people are taking some sugar in, and we'll see how this goes. So I'm Stuart Stoyan, ex-Money Place and FinTech Australia, now helping out the beautiful people at EY on all things FinTech and supporting the team there. We've got a fantastic panel lined up for today. I'll let the guys give a quick introduction to themselves now, and then we're just going to dive straight into it. So to my left is Leanne.
Thank you. Hello, everybody. Leanne Jones, CEO of Nemo Industries. We are a digital lending platform, essentially a SaaS platform that we on-sell to lenders, and at the end of the day, helping customers to have a frictionless lending experience.
Now we have Lisa.
Hi everyone, I'm Lisa Frazier. I'm Chief Operating Officer at Judo Bank. We're a small, medium-sized business lender, so a specialised lender, and my role runs product, digital, data, tech, infosec and ops.
And lastly, we have Stephen.
Hi everybody, I'm Stephen Duke. I'm Global Head of Marketing at Wayflyer. We're one of the world's largest revenue-based financing providers. So we provide funding primarily to B2B businesses and primarily in the e-commerce space.
Fantastic. All right, we're going to get into it. We're going to try and keep this entertaining and free-flowing, and we'll have some fun with it ourselves. So I've been on lending panels for Intersekt since Intersekt started, and we're always back and we're always here. We are the pillar of the FinTech industry. But so my question to the guys now, first and all, is what role have FinTechs had, and specifically lending FinTechs had, just in shaping overall lending today? Happy to start with anybody who wants to dive in.
I can.
Go for it.
Thank you. I think we play a really pivotal role in that we bring to the fore things that we perhaps didn't think were possible, particularly, I think in the morning address we heard things around the fax machine. We used to have things like the BlackBerry, and I think we're moving into a generation where there are things that we imagined and FinTech companies are really putting them on the floor. Things like having frictionless lending, a complete digital lending experience. I think a couple of weeks ago, I was in another conference and they were talking about the battlefield, the time to yes, and that used to be on everyone's lips. I'd like to say, and I think the FinTechs are really pushing the boundaries, and it's more than just time to yes now. It's about time to money in bank, where I think it's at the moment. So we're definitely pushing the boundaries is what I think.
Lisa, Stephen, yeah?
Yeah. So I would agree with Leanne. We're also, I think, really important in filling a void in the market. So Judo started because small and medium-sized businesses couldn't get capital, and today can't get capital from the major banks. It's just an unloved segment of the market, and yet it drives the economy. So I think there's a role for us to play, not on only making it lending frictionless, transparent, so customers, whether business customers or consumer customers, actually understand what they're doing, because there's a lot of jargon in financial services. But we are here to also meet unmet needs.
And Stephen, you're filling a void within a void, if you want to expand on that.
Yeah, I was actually just going to expand on that exact point. So I think the role that we play as a FinTech is in filling a void for businesses that didn't even exist, 5 or 6 years ago. So these very new businesses who have a very specific set of problems, which traditional banks probably don't cater for very well. And FinTechs are really good at doing that. They're really good at picking up on that niche, a niche in a void, whatever you want to call it, and creating a really good specific solution for that problem.
Absolutely. Now, you've brought up traditional banks. Absolutely, FinTech lenders are filling in new niches, serving new customers. But arguably, I'd posit we're also doing it much more efficiently and much better operationally. What are your thoughts there? And maybe just start with you, Lynn, given that you support a bunch of lenders doing this.
100%. I think we're niche, we're specialists. That enables us to be nimble. I don't really want to say the word agile, but dare I say, we're agile, we can move really quickly. It also means then we can bring things to market very, very, very quickly. I met with a lender a week or two ago, a large lender who was sharing with me that they have a team of about 50 developers and have quite a large spend. They must have quite deep pockets. I mean, that's not the case with FinTechs. We're back to Lisa's point and the other point that was made, we're definitely filling a gap in the market to bring things to market much quicker.
And Stephen, how do you think about continuous improvement and sort of continually refining the proposition and the service that you guys are delivering?
Yeah, well, I mean, I think a lot of that is just baked into the culture of working at a startup or an early stage company. It's like we probably don't even think about it. And I'd say a lot of the people in this room, if they work for a similar early stage company, it's the same. And I think the reason is because if you don't, like, it's all we do, so we die. So it's like either you figure out a solution, you continuously improve, and you get really, really good at it for your customers. Like, there's no other part of the business for us to rely on that's going to come and save us. It's like we either figure out how we do this really, really well, or that's it. There's nothing else. And so I think that kind of constant threat of death is actually a pretty good motivator.
And to sort of close this thread out with Lisa, a lot of the judo team are ex-NAB, as well as other banks. What is it that makes judo so successful that can be achieved as judo that couldn't necessarily be achieved within the great ivory towers of a big four bank? Recognising that Lisa's also part of a listed company as well.
Yeah, so we listed in November, and we just did results. But so look, I think there are a few things. It's quite similar to, in some ways, what Stephen said. The advantages of startups, and I've spent most of my career in San Francisco up until last year, is a single purpose mission. So everybody gets behind that. When you compare to a major institution like a big bank, there is so much fragmentation, and any time an executive change, the priorities change every couple of years. And so that's a disadvantage for a major bank. And then I would say part of the other success story for judo is also our culture. So we talk about, as a startup company, we had no legacy technology, we had no legacy processes, no spaghetti, which is all true, but we also didn't have a culture. And when you think about what goes wrong in financial services, and the culture and the bureaucracy, the frozen middle of a company, in big institutions, we don't have that. And I think that is part of a combination of our competitive advantage.
Now, we talked about time to yes. What is it exactly it is that FinTechs have done that have improved customer outcomes? Because time to yes is one component, but there's a bunch of other things that you guys are achieving too.
I'd say in terms of shifting the dial, we're moving from time to yes to time to money in the bank, and that's what Nemo's been able to prove with complex loans, home loans. We've tackled the home loan market, and with live customers, we're able to get money in the bank, get a customer from inquiry all the way to money in the bank in the same day. I think that's a game changer. It gives the buyer, the customer, confidence. It's really been obviously beneficial to the lender. It takes that customer off the market. improves efficiencies, allows them through those efficiencies to redeploy resources to have other enablers in their business.
Yeah, there you go. Yeah, Lisa, jump in.
Yeah, I'll add. So a couple of things we do is we believe in relationship-led banking. So our bankers are actually out meeting customers all the time. It's part of the first step in actually making a credit assessment. But those bankers are also empowered to make a lending decision. So they have a lending authority, we call it the Judo Lending Authority, and they're empowered in market with, and if they need to bounce it off credit, the credit managers are also in market with them. There's no going to a head office, there's no waiting 6 to 8 weeks for a model and a rules-based decision. And that is really important, because when a banker can turn up in front of a small and medium business and say, here's what we think we can do with a term sheet, changes the game.
Stephen, just your perspectives on that?
Yeah, I think I don't think it's too complex. I think we could probably all list out the things that customers care about, right? It's speed, it's simplicity of the process. Nobody wants to spend days or weeks of their life filling out long application forms. It's price, and I think fintechs have not all the time, and a lot of time they actually start off as more expensive options, but over time are getting much more affordable as well. It's quality of service. So how well can you actually deal with your customers, and what support do you provide to them? And I think the last one is where can you go above and beyond? Like outside of, say, the core product that you're actually providing, what other services can you provide to solve some of the other problems that your customers care about? And so it's no mystery, right? We all probably could have said the main things that customers care about, and I just think fintechs have largely done a really good job at executing on those.
Is that also the singular focus that fintechs have, in terms of it helps you to be able to then focus in on customer needs as well? Whereas, I think, at least to your point, it's very hard navigating around a big bank. It's more about the navigation than the outcome.
Yeah, but I would say as a startup or early stage company, you actually have to focus on your capital and capital raising. So it doesn't matter how singular focused you are on meeting customer needs, as Stephen said. If you don't have a capital runway, you can't help a single customer. So you actually have to have a mix of capabilities in your team that can, in our case, raise money and lend money, and they're two different skill sets.
And does that also then move into partnering as well, I guess, in terms of, I mean, you sort of touched on this, Stephen, in terms of meeting a broader set of needs, and how do you guys each sort of think about partnering?
I can probably share a thought there. Powering partnerships, and I see that happening at the conference here today, the networking and the partnerships, and I wonder if that's part of the evolving landscape of lending. Certainly as a vendor, we're all about partnerships because we are long and deep and specialists in digital lending. Perhaps maybe not for some of the bigger lenders, but I think there's certainly a gap for perhaps tier 2, tier 3 lenders who, the commercials, they don't have the commercials to build it themselves. So I think the partnerships are very real, and I think that's in the FinTech land, it's really the trend of the future in many ways.
Is Judo partnering yet officially, or is that something you guys are looking at and considering? So say there's a regional bank that doesn't have a SME capability, is that something you guys would consider?
Well, we would never say we'd never consider all sorts of things. So we do a lot of partnerships, but we haven't yet gone that far. So we are back to simplicity and single focus. We're still mainly driving lending business, core business lending. Over the years to come, we hear of other opportunities to meet small and medium-sized business customers' needs, and partnerships will play a big role for that. We fundamentally believe it's an ecosystem, and finding the right partner is actually really an important skill set for any company, I believe, today, to actually be able to not just vet technology or product, but the people in the organisation too, for success.
It also gets to, I guess, who you platform with. So from your perspective, Stephen, who do you guys partner with, and what does that look like in terms of, say, platforms that you might help amplify and work with as well?
Yeah, sure. So, I mean, we partner with and use so many different companies, right? Because was actually listening to a podcast on the flight down this morning about Amazon and AWS and Jeff Bezos' focus on, you got to just focus on what makes your beer taste better and outsource everything else, right? And the great thing is that as a FinTech now, there's so many other great FinTech solutions out there so that allow you to really only focus on the parts that you can be differentiated on. And so that's a really big focus for us. Like we partner, of course, with like folks like Stripe and Shopify and all these great businesses because that's what allows us to focus on the bits that really matter to us. Like we don't need to go out and redesign payments, right? Like that's not what's going to make a difference to our customer.
I'd agree with that, Stephen. I mean, looking at the talent in today's, festival, for example, there are so many niche fintechs providing different slices of the pie to the solution, and we've got such talent in our region, and it makes sense to partner with where the talent is and the SME is, and then focus on how you brew your own best beer.
Yeah.
So, like US statistics, but back in 2010. You'd be lucky if one financial product was launched a year. Like they were the actual statistics. And then 10 years later, it's like 15, 16 a year. I mean, and that has been, right, the ability, for organizations to partner through cloud and technology changes and the cost of computing. And that has opened up, right, the evolution of FinTech. Because 15 years ago, people would have said, particularly in Silicon Valley, do we really want to go in a regulated industry? And you play that forward now and everybody's in every regulated industry. So, but it was actually the fundamental change was the ability to use technology to enable partnerships and the lower cost to start a company.
There's also been, and we're completely off script now, so we're just winging this.
Say that's what you wanted?
No, we did say that was part of it, but now we're going different directions, which is historically it was more fintechs putting banks out of business. And it was fintechs versus banks or versus traditional sort of lenders. Now it's much more collaborative and there's much more partnering. What do you think has driven that? Is that because bankers are now running fintechs and that sort of gives you back channels, or is it also that banks have just changed their mentality a little bit?
I'll start. So there was a theory, and it was largely driven out of Andreessen Horowitz, that there was one financial service app for everybody, meaning you didn't want to have different financial services coming from different apps. Like that was the premise, early fintech investing, and then that's proven not to be true, right? So once they realized that it was like we can take over every service that a major bank or incumbent bank does, that's not how consumers interacted with financial services. It broke down of the us versus them. That's what I think, anyhow.
Yeah, I also wonder, consumers are after variety. New generations are coming through. They want access quickly to a variety of options. The monolithic systems of the past, perhaps some of the bigger players, they're looking for alternative options, and that's opened up the discussion. Open banking, of course, is on everyone's lips, and I think that also opens up a conversation around different solutions and enabling people to be in control of their own financial success and goals.
I mean, I don't know that I have a good answer for this. I think it's probably a pretty
in that case, we'll move on to the next.
But I do think there is, to actually use the do what makes your beer taste better analogy again, right? It's the same thing, right? So what, like, fintechs have perhaps been very good on the customer experience and the front end side, but banks still have balance sheets, right? And so that's a really forces you to have to partner with them in certain ways. And then I think it's also, we need to recognize it's so massive. When I think about trying to create that one service that does absolutely everything for every different type of customer and every different financial service, it's ridiculous. Look at the biggest fintechs in the world, the likes of Revolut coming out of Europe. They're absolutely massive, and there's still whole realms of financial services that they can't yet provide. So it's just such a mammoth task, and I think we probably underestimated how big it was at the start.
Wasn't it a former CEO of Westpac who said that we're a 200-year-old fintech? So I guess that points to, these large-scale financial services businesses are built over centuries, not sort of years. An area that fintech lenders do excel in is in data. Keen to get your thoughts around what is it that's helped, meaning that fintechs are able to actually sort of dominate in the data space. I guess, Stephen, particularly for you guys, because what you guys do with data is super impressive.
Yeah, so maybe let me start by giving just a quick overview of what we actually do. So we provide finance to e-commerce businesses. And so how we assess their worthiness of finance is actually by plugging in to all of their online commerce platforms. So, for example, if a business is running on Shopify, they plug in their Shopify to Wayflyer. Well, they'll also plug in their Facebook ads, their Google ads, their Google Analytics. And so what that gives us is an incredibly powerful picture of the health of their business, because that's what their business is. Their business is a Shopify store, and it can be doing hundreds of millions of dollars, but it's still all going through a Shopify store. And so we have this huge amount of data that can be incredibly predictive in terms of their future performance as well, especially now that we've worked with tens of thousands of e-commerce businesses. And so it's that type of data, which is a very different type of data to what we traditionally look at when we think about credit decisioning, that allows us to make really good underwriting decisions. So that's what we do, and kind of our USP is all around our underwriting ability, and that's what allows us to provide funding to the good customers and to provide it to them at really good rates as well.
What about SME lending? I think you guys famously make your interviewees sit a test, or was that, I remember that from a year or two ago. That could have just been PR to help sell a book.
No, actually, all bankers who apply to Judo go through a rigorous interview process, and including a credit assessment. And what you're referring to is half the bankers who apply to Judo fail in the credit assessment. So data is really important in lending. I mean, let's not get that wrong. It's also important to the regulators. So it's fundamental to how we think about the future of lending. I think it's really important to understand how data underpins a banker and customer experience, and how a banker can actually help a customer achieve whatever their ambition is. It's not good enough to turn up anymore and say, hey, hi, I'm here, which is a big step forward compared to the majors. The bankers actually have to add value. So the Judo bankers are consulting on all sorts of things around business growth, to manage buyouts, to all sorts of different things. It's a lot of data underpinning that. And
then consumer space, we've got things like CDR happening and transactional data. What's happening there?
In many ways, I think having access to more data and CDR, data gives us choices. It gives us more choices as a consumer and more choices as a lender. And if we think about credit decisioning, we have access, through FinTechs and the likes of Nemo, access to live dynamic data that's instant, that has a single data lake. The other thing I'd add to the data integrity and governance, and data is important and how we treat it, is how we, if we look at past practices where data gets lost or mismapped or it's erroneous or just goes into the ether somewhere, the new space of digital lending allows us to have more governance over that process, and enables at the end of that process the customer, the consumer, the lender to have more choices and more informed choices in particular.
Awesome. So we'll open up for a question or two from the audience in 1 second while you're thinking of those amazing questions, and we get the guy ready with the roaming mic. How do lenders now scale profitably? And maybe start with you just on this list, because you guys just came out with a result. You're 2x prospectus. You're a big lender, but still very early stage in terms of profitability. How does profitability scale?
That's my day job. So we would have said chapter 1 is start the bank, and chapter 2 is scale the bank. So we're very early, like if you think of a story. And essentially we have a flywheel going on the business model, from the ability to lend and the quality of our credit portfolio. And now as we're scaling and hiring more bankers and serving more customers, and then also serving new customers and existing customers, it all comes down to the unit economics, right? It's all about driven by the unit economics of a loan. So to acquire, originate, settle and service a loan. And so my team and I are driving through all the opportunities to optimise around a unit economics of a loan, while maintaining customer NPS. and employee NPS. So, you know, a lot of people will say, and I think you asked me this too, Stuart, is it harder now than is chapter 2 going to be harder than chapter 1? Chapter 1 was like get a banking license and all the regulatory stuff and raise capital, and chapter 2 is just as hard, I think.
Can I add to that? I think Lisa's absolutely correct. There's so much to balance when you think of profitability, but the unit of economics is critical. And I know at Nemo, if we do the math and the research, an average size lender, it might cost circa $900 to originate a loan. Where their profitability might come from is deploying some new approaches and solutions like Nemo, where we can get that same loan to originate in a much quicker time, and in fact get that money in the bank the same day of inquiry. But we can do it at, you know, circa $200 to originate. So the economics on that, it's $9 million profitability piece each year.
Any thoughts, Stephen? Or we're open to the audience, and somebody can ask you a question about your amazing moustache.
Well, I actually just have one interesting point, right? Because I think there's been some talks today about, you know, going global and internationalization. And I think the interesting lesson that we've learned is because we're focused on this, we're focused on a vertical, right, which is only e-commerce businesses. And we get really good at building technology to be able to finance e-commerce businesses. That the way that we scale, and we scale profitably, is by being able to expand into new geographies very, very quickly. So within 2 years of us launching, we were in 12 different markets across North America, Europe, Australia, and New Zealand. And so as a FinTech, a lot of your costs are fixed costs because, you know, you're employing engineers and product people to build this technology. But then once you're able to do that, by expanding your market, that's what actually helps you to scale and scale profitably, which is very different to some other businesses that are purely focused on a specific region and looking at how they can expand within that region.
You can get market share quicker, faster, broader.
Yeah, 100%, and it's surprisingly quick for us to be able to land in a new market and expand within that. But again, it's because we focus on a vertical. If we were going in and trying to target every SMB in Germany, that would be super, super hard. But because we just have this vertical, it's a bit easier.
Awesome. Let's see if we've got a question from the audience. If anybody, hey, we've got a hand at the front, third row. Wait 2 seconds, the microphone will be with you in about 4, 3, 2, 1. There we go.
Everyone must be coming down off their sugar high.
It's been a very pleasant crowd, I will say that.
Great conversation, guys. Thanks so much. Some really good insights there. Lisa, a quick question from you, and it's probably asking you to expand upon your thoughts with Chapter 2. Judo has, gone on quite an innovative journey over the last couple of years, and question is, you spoke around the fears of the frozen middle. How do you avoid that as the business scales? So how do you face into the challenges that big banks have around technology, around hierarchy, around bureaucracy, whilst maintaining that that real commitment to innovation and product development?
Great question. Not easy. It's a day by day sport. So Joseph Healy, our CEO and founder, would say his biggest fear is waking up and we're a mini-me bank. And that's language across all of judo, right? So we know what our fear is. We also have a challenge in that we are a regulated bank, and therefore there is bureaucracy associated with that. And our challenge is to ensure that as we approach the bureaucracy related to being regulated is as tight and as effective and as efficient. We challenge how many board meetings we have. We challenge how many papers we really need to write. What's the length of the papers? We challenge every single thing on a continuous basis, because if we don't, and as we hire people coming in fast, right, that frozen middle is definitely the risk. Our induction program is actually really important as well. So the entire company, anybody who comes into judo spends an entire week learning about the company, and I mean everything, how treasury works. So if you go to a major bank, you don't know how other parts of the bank work, but people have come into judo and why are they telling us They're telling us everything, the whole secret sauce about the whole company. Because we believe if we share how everything works today, people at Judo will find will bring new ideas to make it different and do it differently forward. So there is a lot of, now we're starting to actually things around agile blueprints and processes, right? We are trying to actually measure velocity and a whole bunch of other things we haven't done before. But again, it's with that whole concept of our culture first, doing it by Judo people for Judo, and avoiding bureaucracy. And fear comes with, bureaucracy. So that's what we're trying to stamp out.
I love that. It's like starting as you mean to go. And I think FinTechs, because we're not burdened by the legacy of the past and the cultural blueprints, we have the ability to shape things how we'd like them to be.
And I know at Moneyplace, the best feedback we got that we loved was somebody saying, this was the best experience I've ever had from a bank. It's nothing like I've ever experienced before. It's like, hell yeah, that's because we're not a bank. One more question. Anybody? Bueller? No? Yes? Question at the front.
Interesting question from some of our customers is how do new financial entrants or financial market entrants manage the trust of their customers when they're being asked to provide open banking details, provide their banking details, log into systems, and they haven't got that trust of that new brand yet? How have you dealt with that?
I can't answer that because Pete's with me. So,
So the way we talk to customers about what does it mean, trust, and what is a relationship, and pretty much everybody will say the same thing. So what they want from a bank is say what you're going to do, and do what you say. And if you do that, right, we respect and trust you. So even if we, because of a complexity of a loan, and we say, okay, we need another week, they're okay with us telling them we need another week, as long as you tell them why, and then come back, in a week and have it done. That's kind of the core of it.
I think, so the only thing I would add to that is, and we made this mistake at the start, is not trying to convince 100% of the market at the start, because there's going to be this adoption curve. And so at the start, you might get 5%, but that's all you need. And then once you have that, the next 10% will trust you, and then the next 25%. And so there's customers now who we're working with who 2 years ago thought we were too small, and we're like, oh, I don't know, guys, seems a bit risky. But now, once we're a lot bigger, they come on board. So I think you, just by focusing on the people that you can gain their trust with, is what gives you the stepping stone to the next cohort of customers.
That is super insightful. To close out with 3 more insights in 10 words or less, starting with you, Stephen. What is it that you are most excited about in the next 2 to 3 years that's coming ahead in lending tech? That's one word.
Way to put me on the spot on this one. I think like the flexibility around the new products. I know that's a vague answer, but it's going to.
But that's 10 words. We can take that.
I think it's about creativity, using technology, data, and digital. New things will come.
Cool.
Yeah, I agree. I can't wait to see what we have not yet imagined come to fruition. I'm excited about what open banking will bring, and what that means from an innovation perspective and the lending
Awesome.
platforms.
Thank you very much, guys. You've been very pleasant. You haven't thrown anything. That's awesome. Thank the panel. Have a great afternoon.
It should be good. All right, if I could ask everyone to take their seats, we'll get started on the next session. So next up, we have a fireside chat all about the global shift towards the tokenisation of securities. And joining us for this fireside chat is David Farrell and Tracy Ahi from FinClear. Welcome to you both.
Thank you. Thank you.
Thanks. And hi, everyone. Today it's with great pleasure that I'm joined, that David Farrell is actually sharing the stage with me today. He's the CEO of FinClear, and we are going to be discussing a very new and exciting world where private assets are tokenized and traded on secondary platforms, and the role that FCX is actually playing in that. So Dave, firstly, what actually is FCX and why did you build it?
Thanks, Tracy, and nice to meet everyone. Please, no one else walk out. And we've got a small crowd now on tokenisation. So tokenisation is what we're here to talk about, and the best way for me to talk about that is what we're doing with FCX. So what is FCX? FCX is our private platform for unlisted companies. It's built on DLT, distributed ledger technology. Today it's a registry or cap table management. It will also over time facilitate secondary transactions, primary transactions as well on ledger, facilitated by smart contracts, and I'll talk I think tomorrow more about smart contracts. And ultimately it will become a liquidity venue as well, so an opportunity for companies, early stage companies and growing companies not yet ready to go to, say, a full market listing on the ASX, but avail themselves of a liquidity venue. The reason we build it is really simple. So FinClear as a business is 7 years old. We've gone through 3, 4 or 5 private capital raises ourselves. We have fairly mature investors on our cap table, from large family offices to high net worths, VC funds, PEs. And the resounding feedback through our journey has always been on that side, there needs to be a centralised platform capability to host unlisted companies. And from our perspective, the complexity around managing cap raises yourself as a small company is incredibly onerous, time-consuming and fractured. And so really what we've built in terms of FCX is a platform capability to make that experience much more friendly. And today, you know, we've got lots of early stage FinTech businesses here for those sorts of companies to come and host themselves on FCX, avail themselves of that opportunity, capability.
While FCX is a platform for unlisted securities, is there actually an opportunity for listed companies as well?
Yes, there is. What we're essentially doing is building what I would call a more efficient ecosystem based on tokenisation of securities and smart contracts that enable you to provide a much more streamlined service capability or infrastructure for those companies to sit on, and also for to host other different types of products as well. But ultimately, what it means is, it may well mean that companies want to stay private longer, and there are large companies at the moment choosing to stay private longer, and particularly if they can avail themselves of a platform capability, centralised, tokenised securities, and the ability to get access to liquidity. So companies will stay private longer, we think, but also it's an opportunity for even companies that sit on public exchanges, listed exchanges, where they may decide to go the other way. Smaller scale companies, it doesn't make sense to sit on say, the ASX. The regulatory costs and the listing costs and the continuous disclosure regulatory regime are very expensive. And so you may find that companies decide to go back if they can still get a similar result in terms of liquidity capability.
So all assets on the FCX will be tokenised?
Yeah, so look, as of today, we are our first client. So FinClear today, our cap table sits on FCX. We've got quite a mature or sophisticated cap table in terms of we have 3 separate securities. We have 8 normal A-class shares. We then have an ESOP program, and we have loan-funded shares or a debt facility, debt security also sitting on our cap table. So today it hosts FinClear, and we're onboarding other companies as we speak. I think we've onboarded a few more companies this week, and we've got a very strong pipeline. But the capability is also potentially to list other asset classes as well.
So do you see a world where peer-to-peer can also trade?
Look, that's a really interesting question. At the moment, FCX is what we call a closed infrastructure or closed platform. It's what we call also a non-permissioned, but sitting within regulatory guidelines. And what that means, to get away from all the jargon, is you still need to come on board to the platform. You need to be KYC'd, AML'd, hence the sit within regulatory guidelines. But once you're on board, onboarded onto platform, then you can trade potentially, and as the liquidity comes online, peer-to-peer. Now, in terms of it being completely decentralised and for anyone to come on board to that platform, that's some time away. We have the capability to do that over time, but of course it's subject to regulatory regime. One of the things that we've done with FCX is build it within that regulatory regime, within those rails, because we think that these businesses need to be regulated. There needs to be transparency from a regulator's perspective, and the technology that we use in terms of the DLT and tokenisation of securities needs to be in a trusted ecosystem for now. But of course that will likely change over time, and that's, we hear that the whole time, and that's obviously why we're here today as well.
So Visa has recently announced that it's issued more than 4 billion tokens worldwide. This is more than double the total from 12 months ago. And for the first time ever, it's actually more than the physical Visa cards that are in circulation worldwide. This has meant that they now have over 8,600 issuers and 800,000 merchants that are using the service. And it had led to phenomenal results where there's actually been a reduction of 28% in fraud rates and improvement of 3% in approval rates. With such significant results, is tokenisation going to be the future of our financial ecosystem?
The short answer is yes. The long answer is it's more about the technology. So it's more about the distributed ledger capability and then the smart contract capability that layers over that. And to put that into a bit more context, at FinClear, so the company, obviously parent company of FCX, we sit over and we do millions of transactions a year in listed world. And it's a pretty inefficient ecosystem, and listed markets are globally highly regulated, high capital requirements, what's called T+2 settlement, all makes it a very cumbersome environment. What distributed ledger technology does is potentially enable, and to your point before, enable peer-to-peer counterparts, but the smart contract capability and layers that puts around it starts to let you automate functions. If this happens, then that. And so from a infrastructure perspective, we have today about 180 people across our business. We manage millions of transactions in listed world. We're just looking to apply this technology also into that old world over time and create more efficiencies, because it's about the efficiencies that you bring. It's about what we call the layers of fees and counterparts that you can remove out of an ecosystem and make less touch points.
So when do you think that tokenisation will become the norm?
I guess, well, I would say tokenisation in Australia has, in a more simple form, been with us for 30 years. It's no surprise that I've been for some time a big supporter of the ASX CHESS replacement project, and I think we've got members of ASX here with us today. That project hasn't been without its problems. However, the concept of it and what they're doing is very forward thinking, but you've got to also look to what they did 30 years ago, which was really groundbreaking. Because here in Australia, we have digitisation of securities. We have the capability for end investors, retail investors, to hold securities in their own name. Now, for people who buy and sell shares in Australia, you say, well, so what? But if you go to any other regulated market globally, it's a different infrastructure. You don't hold shares in your own name. They're held by a custodial bank that then runs a ledger beneath that. And you lose a whole lot of benefits that we here as Australians have around direct ownership of shares. So CHESS was introduced as a means to hold digitised securities directly. And so I would say Australia's in a great position to actually be at the forefront of tokenisation of securities and other asset classes, because we've had an early form of this for 30 years. Investors are used to getting a CHESS statement or getting a statement from their broker and showing name on register. Tokenisation of securities is just an evolution of that. And what tokenisation does is start to put smart contract capabilities around those securities. Again, to my point before, if this happens, then that. So you start to remove touch points in particularly our world, a clearing and settlement infrastructure where it's a much more straight through process. And so those efficiencies are what's going to be the benefit of everyone over time, and why I think that the ASX CHESS replacement project, while being difficult and very complex, and they would say the complexity is what's causing the delay, is such an important milestone for the Australian market.
So the ASX Symphony project was hailed as taking the latest step towards tokenisation. Is the ASX going to offer tokenised trading soon?
Well, to my previous point, sort of, when CHESS is replaced, it'll be sort of tokenised trading. But it's not really about that from my perspective. It's the efficiencies that the smart contract capability around clearing and settling, automating things like dividend streams or share splits or rights issues, those sorts of things as well, rather than very manual processes that we undertake every day today. But so Symphony, though, and again ASX are in the room, Symphony is about DLT as a service, and it's inviting other participants to come in, like ourselves, to build onto the distributed ledger, start to add other asset classes. So we're obviously adding unlisted securities, unlisted companies, but in essence, you could add, or we could add, any type of asset class onto the distributed ledger. And then what you start having is a series of tokens of different asset classes that can sit alongside listed securities within CHESS as well. And what I call it is, it's about building a wealth platform from the inside out. So wealth platforms in Australia today, most of the big bank ones and the independents are what I call bundled from the outside in. When you go into a wealth platform, all your securities get put into a custodial relationship. So you become a beneficial holder only of those securities and assets sitting in a wealth platform, and you lose the direct investor experience, and you also lose the 24/7 always-on capability. So there's a couple of things about what we're doing here. Is firstly, we're building from the inside out. So we start to add other products, other asset classes that can be tokenized and sit alongside listed securities. And so an investor can start to see their investable world on tokens. And so, that's one of the, a very important step for us, and that's why we're involved and working with the ASX around CHESS replacement, but also why we decided to build FCX, so that we can use that technology both in an instance to solve a particular problem, which is unlisted securities, but to add other asset classes and start to build a more holistic wealth platform based on tokenization of securities.
Ultimately, will this result in democratization of financial investments with cheaper, easy access to products, as well as liquidity and direct ownership?
Again, short answer, absolutely yes. And to my point before, once you start to tokenize securities, once you start to have that peer-to-peer and marketplace, you start opening up to a what I call the new demographic of investors. So I think one of the amazing things that's happened over the last few years around all the development in crypto assets, good and bad, and what's going on there, has been the adoption of technology, of the distributed ledger that underpins it. So the great thing that's come about it is the actual core technology and how that is now being used to provide access to more products and to provide a more efficient and secure ecosystem, and potentially an ecosystem where intermediaries are removed out of the equation, and that capability over time for peer-to-peer interaction. One of the things that I've been very critical of over the years in terms of financial markets, and what I call the old world of financial markets, are the wagon wheel of service providers that add layers of fees around it. So if you look at listed markets at the moment, you have an issuer, obviously, and an investor, and a market to join them together. But then you have a whole range of other service providers, ourselves included, by the way, but banks also, custodians, fund administrators, trustees. The list sort of goes on. And so what I think the DLT and smart contracts enables is the capability for super service providers to start to take away these layers of fees and inefficiencies and bring investors together, potentially over time, peer-to-peer. But I think in terms of regulated markets and products, that doesn't happen for some time because the regulator needs to maintain that oversight transparency. But that's eventually where I see it going.
So I'm going to open the floor to questions now, and there is somebody with a mic that will come to you. So any questions? Yep, over there.
For a lot of DLT use cases, there's a question around scalability, and Once it gets bigger and bigger, how do you sort of solve for, efficient processing and so on? What's your view on that?
Look, first and foremost, I'm not a tech guy, so I'm not going to get into the details on that. But remember, this is a closed ecosystem where we're using the technology, the distributed ledger capability. We use it for one pure action, and that is exchange of an asset or something else that's intrinsic to a security that sits on it. We don't then start to add multiple layers and complexities. We use what we call our heritage infrastructure, our microserver cloud-based infrastructure to sit around that. And so the infrastructure that we've built, doesn't rely on mining and minting and power to actually, mine coins. It's using the code base to facilitate a transaction. And from my limited tech capability, our core transactional capability is way beyond where we envisage this application going.
Thank you.
Question over here in the third row.
Thanks so much, David. I was just wondering what your thoughts were on what's the low-hanging fruit in terms of assets classes over the next 5 years? Like, is property? Is it listed securities? What's the low-hanging fruit, and what's likely to be the best use cases over the next 5 years?
That's a great question, and I can answer that really, really simply, because from the day we launched FCX, we launched it as a solution to a problem in terms of the low-hanging fruit, which are unlisted companies. And we know that in Australia, there are about 1 million unlisted companies, we believe. Now, lots of them are probably mum and dad partnerships. But even if you distill that down, there are literally hundreds of thousands of reasonable scale, small companies. As of today, ASX sits on about, I think, 2,700 companies. So that's a big opportunity there. And that's the low-hanging fruit from our perspective. But from the day that we announced and launched FCX, we then started to get reverse inquiry on the unlisted fund side. So unlisted funds started coming to us, and some very large, big global counterparts saying, could this be a venue rather than us going into a full-on IPO and public listing through an ASX route? Could this be a capability for us to manage our investors and have regular liquidity events on an unlisted fund? And the answer is absolutely yes, because an unlisted fund looks very much like an unlisted security. And then there's the opportunity I spoke to and Tracy asked me about before. There are subscale companies sitting on listed markets at the moment that potentially this environment would be more suitable for as well. And then we've also been approached by other asset classes as well. So debt instruments, insurance instruments, commodity instruments as well. But we're very focused on what we think that big bunch of low-hanging fruit is today, unlisted companies.
Thank you.
Any other questions? Well, I have a final question for you.
We're almost on time.
Yep.
One more question, Tracy.
I've actually met a lot of early stage companies here today, and certainly FCX potentially would be a venue for all of them. So what's the roadmap?
Yeah, thanks, Tracy. Great question. Doing your job. Let's me talk about the roadmap and where we are today, because the platform's not complete today. As of today, the cap table is live. The registry capability is live. So as I said, our company FinClear is on FCX today. But what it looks like over time, we start to build automated processes. The pain points that came to us around capital raising, So all the documentation shuffle that needs to happen between a registry and the lawyers, a capital advisor or an investment bank, company secretary, issuance of share certificates, gathering subscription monies into bank accounts, all those very manual processes that happen at the moment in an unlisted company environment start to get automated through those layers of smart contracts that we start putting over the tokens. So that gets delivered in the next few months. We also bring cash onto token as well, and that will be in the very near future, in the next month or so. So that allows cash to be deposited into an omnibus account, but to be tokenized on platform. And the great thing about that is that once you tokenize platform, tokenize cash onto platform, put it onto ledger, you can start to do really exciting things like atomic settlement of transactions, meaning that if you have buyers and sellers of shares, then it's an instantaneous transfer of title of those shares and cash, because it's all sitting on ledger, facilitated by smart contracts. And that's the component to me that's really exciting, because that then starts to put efficiencies, or the capability for us to put efficiencies back into our other business, or our more mature listed business, which again is why we've built FCX as a precursor to where we think listed markets over time goes. And then the final piece in terms of the roadmap is the liquidity venue. And that's probably not until next year sometime. And that probably requires a licensing capability as well that we need to work through. But once you bring those components together, the cap table and smart contracts sitting on ledger, the automated functions to enable primary and secondary, and then liquidity for peer-to-peer to start trading with you, we think that that's going to be a pretty cool piece of infrastructure. Today, that capability to bring companies on board, so we've brought a couple of companies on board in the last week or so. We moved out of test only a few weeks ago and started onboarding private companies just in the last few weeks, and that's the first step to get them onto ledger and to tokenize those securities. So stage 1 done, stage 2 in the next few months, and then that full liquidity venue not until next year sometime.
Well, thank you so much for your insights today, and please join me in thanking David.
Thanks very much, David and Tracy. We'll give it a few minutes and then we'll get started with our last panel for today. Alrighty, for our last panel today, we'll be speaking about where Web 2.0 and Web 3.0 collide. Joining us for this panel to talk more about the intersection of technologies and experiences is Jeremy Balding from DigitalX, Ellie Rennie from RMIT University, and sorry, I'm going to really butcher this, but Leah Dashkina from Reinventure Group. Welcome.
That was perfect. Thank you. Hi everyone. Well, last session of the day, and we're competing with James Cameron from Etri in the other theatre, so no pressure. Right, so today we're talking about where Web 2 and Web 3 collide. Very, very broad topic. So we thought we will sort of zoom in a little bit and talk about DAOs and where DAOs cross over between Web 2 and Web 3. So my name is Leah Dashkina. I am with Reinventure, which is a venture capital fund that invests predominantly in FinTech, but also some adjacencies, which include blockchain. We've got Jeremy and Ellie today, and I'll get them to introduce themselves before we dive in. Ellie, do you want to go first?
Yes, sure. I'm a professor in the RMIT Blockchain Innovation Hub. Most of my research involves ethnography, which means I'm embedded in these protocols and communities, and that's how I understand them.
So Jeremy Balding, I am not a professor. My background, I've come from financial markets, so I'm used to operating in very regulated environments. I've been in this space for 4 weeks, so you're probably looking at the bookends for our experience in the sector.
Right, so DAOs, decentralized autonomous organizations. Very good fit for a decentralized world of Web 3. But they are now sort of spilling over into the world of Web 2. And that's what we wanted to discuss today, and sort of how they fit in or not fit in, what are the use cases, and from Jeremy's perspective also how the wholesale investor might consider DAOs and look at them. So if we start from the beginning, sort of, could we have a quick recap of how it started and how it's going? Ellie, do you want to go first?
Yeah, sure. I mean, from a very top-level perspective, I think where Web 2 and Web 3 collide is at the intersection of probably innovation and competition. So Web 2, as we know it, it kind of tends towards monopolies at the platform level. It involves harvesting a lot of consumer data and the like, whereas Web 3 is, I suppose, multiplicitous. It's composable. You have various communities and applications bubble up as needed and required, and in a permissionless form. So they're kind of two polar opposites. In some ways, I think we also have polar opposites on this panel here, arguing for and against in a way. But what I mean by innovation and competition in this respect is I think it's really important. I just want to set the stage to say that we need to find a way to advance DAOs and decentralized protocols and the applications upon them in a way that in fact enables them to put pressure on Web 2 because they succeed at different margins. Web 2 has had decades of advantage in terms of usability and how it kind of brings people into its literally web, whereas Web 3, as we know, is trying to do things in a trustless way. The last two sessions, I think, kind of encapsulated this wonderfully, where we had, on 2 sessions ago, someone asked about public trust. And one of the panelists said, well, it's you say what you do and then you do what you say. And then in the last session, we just had a discussion around smart contracts and this idea of kind of automation and assurance through the ability to create software that executes when certain, say, votes or whatever it might be, outside data points are met. So we've got two absolute polar opposites in terms of what we mean by the web when we're talking about Web 2 and Web 3. But before we move on, I just want to do one thing, which is who wants me to raise hand, who would like me to try to define decentralized autonomous organization before we go any further? Okay, there's a couple of people. Okay, so a decentralized autonomous organization, or a DAO, is essentially a group of people coming together and performing tasks, for instance, something like governance inside a company, corporate governance, through the use of these smart contracts and other software capabilities. So people can come together from any jurisdiction. They can be pseudonymous, they might not be known to each other, but they can rely on these smart contracts to perform certain functions. So they don't. So one explanation that I've heard, which is quite popular, is you could think of it as a subreddit with a treasury. So how do people in that subreddit actually know if everyone else in that subreddit is going to do what they say when it, say, comes to spending? Well, you can do that because the smart contract provides you with the ability to. So that's kind of a very basic description of a DAO. But as we're going to talk about, that raises a whole lot of issues around corporate governance and compliance and how that fits in with the external world.
Yeah, and I guess to respond, so from my perspective, having spent my entire career working in a heavily regulated environment with a lot of rules and structures to ensure trust, and even now within the the business that I work in now, so Digital X, we're a FinTech company. We have blockchain consulting, we have a RegTech arm, and we also have the funds business. But even still within the funds business, to ensure we fit within the regulations, there's certain things that we need to do, which we're ultimately centralising the decision making, we're centralising the custody, we're doing as much as we possibly can to ensure that we fit within the structures that are currently in place, to ensure that we give the safety and security to the investors. So the funds that we look at are wholesale up, so anywhere from wholesale to family office, all the way up to institutional. So we're certainly open to the idea of going towards that model if we could find a way to get comfortable and get investors comfortable with it. But right now, the regulations require we act in more, I guess you'd call it a Web 2 way rather than Web 3.
And I guess just to add to Ellie's point, a good way to describe that I've come across is a DAO is like a co-op, so a cooperative that forms around either a particular topic or a goal, or maybe purchasing an asset. And we see a lot of the protocols are run through a DAO structure. There are community DAOs. There are now also service DAOs, which are formed around a particular profession maybe. So if you're providing services in Web3 marketing, for example, you might operate as a DAO. And there's not one centralized entity that makes the decisions, but in its purest form, I guess it's decision by committee. Right, so from the wholesale investor's perspective, Jeremy, obviously DAO is a really good form for a decentralized world, but institutional and wholesale investors don't necessarily like or can't necessarily play within decentralized pure play situation. So how do you find that they look at that? How do they think about it? Is it of interest? Could you talk a little bit around that?
Yeah, so look, as the short answer is, right now they're not there. And I think there's a lot of, again, going back to the structures, there's insurance, there's KYC, there's AML, there's a whole lot of reasons that they can't get comfortable with it. Not to say that it won't happen at some point in the near future, but right now I think the appetite's pretty low, sort of very low.
And Ellie, anything you would like to add there? I think we spoke a little bit the other day about governance and DAOs, and that being a barrier for institutionals as well.
Yeah, look, I think that DAO governance via a DAO, and look, the reason why we would need governance via a DAO over something like a decentralized exchange is it's actually not decentralized if you then have a corporate entity located in whatever jurisdiction who is ultimately making decisions. So, I mean, you need decentralization at the governance layer, or at least a kind of ability for people who have a stake in this, in whatever that protocol or product or community or syndicate or whatever it is that the DAO is representing, or that the DAO is. So you need these kind of decentralized means of coordination, which is what the DAO is for. So just to be clear there. But these are very, very new in governance world. And there have been some major problems that we've seen. For instance, say you receive a token drop from a decentralized exchange like Uniswap, and suddenly you actually have governance power within this system. And this is exactly what Uniswap did. Anyone who had used their exchange received tokens which gave them governance rights. And you would then be able to vote on various decisions that were, you could propose decisions if you had enough tokens. That was controversial in Uniswap because in fact venture capitalists owned most of the tokens, which we can come to later. And you required a lot to be able to have to meet that threshold. But you are essentially a governor of the web infrastructures that you're interacting with in this instance. You can choose not to accept those tokens, and perhaps then you are not liable. But we don't actually know that under law yet. But this kind of one token, one vote system that's developed has had quite a few problems. So there's this issue of plutocracy, which is where those with the most tokens have significant amount of power. And also, you could take out a loan on a DeFi app, for instance, that would enable you to do a governance attack on that protocol and change the vote in your favour. So what we've seen, and the work that I've been doing with many other researchers and big brains in the blockchain world, are trying to figure out what do we need to do to make governance work in this way. So some of the things might involve systems such as commitment voting, where you actually have to lock away your tokens in order to be able to vote. The longer they're locked away, the more voting power you have, for instance. That would overcome the problem that I've just discussed. But probably the biggest problem that DAOs face with governance is that actually most people don't want to participate and they don't want to have that responsibility or pay attention to every decision that's going on in every Web3 infrastructure that they interact with. So where we're seeing DAO governance evolve at the moment is to say things like sub-DAOs or nested DAOs, where it's more like having a committee structure where you would have experts in a certain topic being able to carry decisions which might then just be kind of finalised by a broader membership similar to other corporate governance systems. So there's a lot of risk in DAOs because they haven't quite sorted it out. But I think the kind of bigger question really that we're facing now is how do we map things which are really good about DAO governance into the laws of countries all around the world, so that those things can kind of be allowed to occur. So just to give an example of that, for instance, when we heard it in the last panel, there's a kind of transparency to tokenized voting in the same way that there might be to tokenized assets that gives us an ability to know what's occurring within this particular entity. And that actually should be able to meet the requirements, the legal requirements around publicity that regular corporations are required to meet. An account, a DAO has an account. So it is kind of identifiable. It's registered in the same way as a corporation, but the law doesn't actually see that at the moment. So a lot of the stuff that we're looking at the moment in as a research field is this kind of equivalence. So rather than say let's make a new version of the Corporations Act, that includes this thing that is a DAO. How do we just say this is what a DAO is, and this is how it actually fits into the existing laws and expectations in the world? It's a fantastic report by a group called Koala with a C. Primavera de Filippi, who was main author on that's coming out to RMIT at the end of the year to help try and bring this into fruition here, because it was mentioned in the Bragg inquiry into what was it? Australia's future as a digital something or other. Basically, the kind of ended up being like the blockchain inquiry last year. Yeah.
So Jeremy, to kind of bridge the gap, what needs to happen? What kind of hybrid structures would need to look like in order for DAOs to kind of come to the forefront and for the wholesale investor or for institutional investor to be able to participate in that space?
Yeah, I think it just needs to iterate somewhere from Web 2 to Web 3 and incorporate. So if you were to incorporate a DAO, I still, unfortunately, there still have to be some level of centralization within the process. So let's say, for example, if I use the lens of an investment DAO, because that's sort of what I'm here to talk about, rather than all the decisions being made by one centralized party, you could set up a structure whereby, let's say, for example, the investment team that has the skills and the analytic capabilities to, almost vet a certain subset of securities or tokens that would then be released into the DAO, and then potentially people could then vote on what is a predetermined subset of securities that you've put a pass, fail, put a rating on. They could then make that decision whether or not to split off a certain component of that and run that as their own portfolio, or run their own portfolio based on that. But I just think unless it's an index type structure where it's, you're replicating in the top 100, if it goes to the level where you've got discretion and you're doing some work behind it, I think you sort of still need investment professionals in the process just to help guide it. Like, this may be the first step. I don't think this is probably the end, but I think if you're to take one iterative step, that probably goes some way to giving some level of control, some level of skill in the process, and maybe getting investors comfortable with that.
And I guess there's also various open questions around custody and what that looks like, and regulation and what that looks like. Before we go any further, are there any questions from the audience to our panelists or to myself? Please sing out because we're almost at time. Did I see a question? Oh, yeah, there's one in the front, just over there.
What would you say is, out of existing DAOs, they're not perfect, but the ones are created for specific purposes, what would you say is the most exciting application where DAO works so much better than any other existing traditional structure? Because that's why we're kind of reinventing governance to make it better. Is there anything that you would single out, this is the type of project and the reasons why it works very well? And then, I don't know if Jeremy has actually the example for the reasons why the current structure would still work in that case, or anything that institutional investor would look at that case saying X, Y, Z reasons why that's still not acceptable for us as a vehicle.
One of my favorite examples was Please a DAO, which was spun up on Twitter over 23 hours. When a video, an animation was released that the artist had decided would raise funds for anti-racism campaigns in the US. And someone tweeted, anyone want to form a DAO to bid on this asset, essentially this NFT. And Please a DAO was formed and ended up purchasing that NFT and went on to purchase a number of others, and even fractionalized the famous Doge meme and did doing many other interesting things. I often, this isn't FinTech, but I think one of the most broken industries in the world is the music industry, and there's some fascinating things happening with DAOs and artist collectives, and a project called Song That Owns Itself is one that I love. But again, it's instances where people are trying to coordinate. They don't necessarily know each other, like artists don't necessarily know their fans, but they might want their fans to have a stake in the song because it's the fans who ultimately make that song known in the world, not marketing companies.
Yeah, so I don't want to sound like I'm always coming from the other side, but I sort of am on this one. But look, I'm a 100% believer in Web3. I definitely think it's got a lot of value. There's speed, there's efficiency, there's peer-to-peer, there's a lot of really good things going on. Where it's just at odds with the investment process and investment structures at the moment, because you'd almost want to know, well, you do want to know, you don't want to know who's voting, how is it being voted, is there a voting score, like how are these people assessed on the decisions of what they're doing, how do I assess that as an investment professional? I need time, I need, to do some work to make sure that if I'm going to commit, or someone's going to commit money into that, we need to make sure we've done the work on it. And, that's a great example. It's 24 hours, probably too quick for me, like for the process. So does that mean my process needs to be quicker? Well, maybe, but right now it's not.
Yeah, but in that instance, that DAO can't do anything other than what the DAO decides, if they want to buy this meme or that NFT or whatever it might be. But I would also say that in some ways, look, DAOs do need to be able to attract institutional investors and venture capitalists in order, I think, for this to be, for some of these new innovations to grow strong and secure the capital that they require. But at the same time, we need to be really careful that we don't just give in to the kinds of needs that you're talking about, because if we do that, we're sacrificing a lot as well. And we're sacrificing, the permissionlessness nature of what Web3 can offer. We're also in some ways, if we wanted to do things by the book, we would just create private blockchains, distributed ledgers, where they're essentially just consortium structures of people who are all trusted among each other that can see those transactions. But those haven't actually gone very far. The coders, the public want public blockchains. They want these permissionless, censorship-resistant infrastructures on a massive scale. So we need to figure out how to make this work.
Okay, suggestion. So just going back to this iterative approach, so just curious what you think of synthetics and their structure, where instead of everyone gets a vote, but they're voting on the council, and there's certain people, I think it's a group of 7 that get elected to then make those decisions on behalf of the DAO, rather than everyone having an individual vote. So that's a step. Thoughts?
Absolutely. I think synthetics, which, that's Kane Warwick, Australian innovator, a legend really, has been innovating DAO structures. And, so they did what's called an exit to community, where they went from having a corporate entity to being fully owned by a DAO. And they do this delegation system where you can delegate your vote. Delegation does work very well, but there's a lot to be ironed out. A lot of, I had a coffee with someone who I delegated my tokens to recently, someone who's very well known in blockchain world. And I said, I delegated my tokens to you. And he said, I never voted in that. It was Gitcoin. He said, I never voted in Gitcoin. And he said, but the problem is there's no term expiry either. They did. So there's still just people who are kind of setting these things up. Still need to do a lot of thinking and looking to what we've already learned throughout the history of corporations and firms.
And going back to the original question, I think the DAO structure is not great for every Web3 project, but when it comes to efficiency, so when you need the power of collective, it works really well, or innovation, to your point about synthetics, right? So in some cases, it will work really well. If you need to pull your resources together and buy an asset, that could work really well. I've got friends who are starting DAOs to buy a vintage race car, and they own it as a community because they can't afford it on their own. Joni Pirovich has started LawFi DAO as an innovation experiment in the legal profession to see if you can democratize legal advice and access for Web3 companies to legal advice. So I think in those cases, DAO structures can work really well, but it doesn't say, like for example, for a traditional startup, DAO might not be the best scenario, even in Web3. And going to the point of VCs and investing in DAOs, it makes it a little bit difficult. On the one hand, you're playing in a liquid market, which is great and very different to normally having your capital locked up for years and years. But on the other hand, there's a lot of compliance hurdles, regulatory hurdles that you need to jump through. And it being an unregulated entity or not a recognized legal entity makes it very difficult. Not least that a lot of VCs in Australia specifically are ESVCLPs, which means they're part of a specific tax regime, and I think investing in a DAO kind of doesn't comply with that. So it creates all sorts of advantages and disadvantages, I guess.
I would say, I mean, for those who haven't been following Three Arrows Capital, which is what has caused the major downturn in the crypto markets in recent months, that's a really interesting case where they were borrowing money left, right and centre. And in fact, it was the DeFi protocols that came out fine because they are automated over-collateralized loans using smart contracts governed by DAOs. It was the centralized traditional entities like BlockFi that really suffered, and many closed because this investment and VC company made extremely poor investment decisions by investing in a stupid algorithmic stablecoin, which really should never have existed, but did because crypto's crazy. So, but I mean, my point here is that there are, I mean, it kind of goes both ways. Like, often the points of risk in Web3 are not these decentralized protocols or DAOs. It's these non-transparent corporate entities trying to make a quick buck off your average consumer layperson who follows Twitter, who are also unprotected.
Do we have time for one more, maybe? Any more questions? No? Okay, any closing thoughts, Jeremy, Ellie, before we wrap up?
Yeah, look, I guess my closing thoughts are, from my perspective, I think at least in the short term, we will probably just have to continue as we are, at least from the seat that I sit in. We'll be looking for ways to try and bridge that gap if we can. Talking to as many people as we can, but I just think right now, not only is that, we have a structure to sit inside, there's certainly a lot of institutional investors that still aren't yet even comfortable with the model that we have, let alone going to the next phase. So I just think we sort of need to, make them feel comfortable with where we are now, and then behind the scenes just keep trying to build and iterate closer to where, I think it's probably going to go there anyway. Like, it's in our future, DAOs, one way or another, they'll be there, and so I think we have to work with them.
I actually agree with you. I think things like ETFs are incredibly important. Crypto ETFs, I mean, like where you can buy Bitcoin or Ethereum in a more traditional manner, are really important also for consumer protection right now. And financial advisors also need them because financial advisors are not advising people on how to be safe in the crypto world because they legally can't. So there's a whole lot of kind of issues that the traditional system has learnt to deal with and does well. So I'm not saying we don't need that. I think we do. And meanwhile, those of us who like really hard problems will try and work with you to solve them as well.
Great, thanks very much. Let's give a round of applause to our panelists. Thank you.
Thank you very much, guys. Thanks for being last as well. And thank you to all of you for staying for the end of the last session. So now it's time for drinks, and I'll see you all here tomorrow. Thanks, everyone.